Well, thank you for taking the time to visit me on this video. I'm Tom Perrone, New England Consulting Group, and today we're going to talk about the cost of wealth transfer, which doesn't necessarily mean taxes, because 99% of the population under the new big bill will not have taxes. But they're going to have other costs, probate, debt, long-term care costs, transfer costs to transfer property, whatever it might be. So how do you pay for that? And we're going to learn a lot today because there's four ways of paying it. So today in the estate and wealth transfer, the whole idea is how do you pay for these transfer costs at the most reasonable way of doing it? Well, if you look at it, there's really actually four ways of paying taxes or transfer costs. One is cash on hand. Two is a forced sale. In other words, take an asset, sell it, even though you're losing market value, and take the liquidity and pay your costs. Because remember, you have a situation where these taxes and costs are due in 9 months. Picture the person that has a lot of land or a building and they have to sell it. I mean, that's a fire sale waiting to happen. The third thing is estate tax financing or wealth tax financing or financing of any debt. And in that particular case, you go out to a bank, they'll give you a rate. That's what you pay over 10 years. That's if they will give you the money. Not every situation is the same. And then, of course, there's life insurance. And we're going to talk about that. And it's really prepaid because with the new law, the new one big bill, we're able now to gift cash into a trust, not pay gift tax. So we've got a lot of room there with the numbers. So let me give you an example. Let's say age 59, and we're going to use Minnesota, and they're going to live 22 years, and their net worth is $15,500,000. And let's say that estate grows annually. Well, the projected estate tax, I'm sorry, value is $46,000 million. The federal tax is 11.9 million. The state tax of Minnesota is 6.6 million. So you have a total tax bill that has to be paid in 9 months of $18,600,000. A lot of money. And when you take a look at the ways of paying it, you could have cash on hand, $18 million. But then if you use that cash, if you had that cash, we're losing 100% of the opportunity cost for the future. So, I mean, I don't know how many states have $18 million sitting around in cash, but let's assume that. You could have a forced sale. Let's say we have a building that we could sell and we could sell it within 9 months and it just happens to sell for 90% of its fair market value. Well, now it's 111%, or it costs $20 million to sell. And then we have estate tax financing where we go to the bank at 5%, pay it over 10 years. Our cost would be $23 million or 126% of the cost. So we have three ways of paying these transfer costs. The fourth way is life insurance, where over time we start making gifts to a trust, a total amount of $4,800,000, which represents 26% of the actual amount of the $18 million. Now, when you take a look at this, the trust-owned life insurance is 74% less expensive than the next option, which would be right here. So when you look at these numbers, you have to look at it and say, well, if I have transfer costs, which you will, how today do I plan for this? And again, under the big, beautiful bill with the exemption credits, it allows us to make gifts to these trusts so that we can fund for cost and other things. So let's break it down. Why life insurance? Well, it's 74% better than the next option. The income tax-free rate, internal rate of return on the death benefit at life expectancy is 10.54, which means you'd have to earn 10.54 on your premium to equal the tax-free death benefit that's paid upon death. And then 17.6 really represents the tax equivalent in a 40% bracket that you'd have to earn on the premium and die at that particular time at 76% earnings on the premium. So when you break it all down, life insurance is the least expensive way of paying for transfer costs. And again, these are, again, the four ways of doing it. And the key thing with life insurance, keep remember, there's no correlation to the market, so that you have guarantees here. It's income tax free, it's cheaper, and you could see the cost. It's actually ascertainable. And thank you, CBS Brokerage, for this material. I have, first of all, I'd like to thank you for taking the time. And if you like this video, give me a like, subscribe. We have videos that come out every month and keep you up to date. And subscribe to this channel. There's a free report you can download in the memo. And if you're looking for another video about this, I put a link in there that'll bring you up to date. So thank you for taking the time to review this little message about how to pay your costs in the estate. Thank you.